Hi, everyone, and welcome to the Stormwall Advisors monthly update for April 2023. I'm Mike Wilkerson. I'm the founder of Stormwall Advisors, the host of Stormwall.com, and the author of Why America Matters. This month, we want to take a look at the banking crisis that has dominated the media, especially financial markets, economic media, and news over the last month. Talk a little bit about what happened and what it might mean. Now, this is an area that I know a little bit about, something about. I spent most of the years during the financial crisis as a financial advisor for Lazard, the world's preeminent M&A and restructuring advisory firm, as a financial institutions advisor, and spent a lot of time during those years around the big banks crisis, whether that was banks or non-bank lenders, or government-sponsored entities. Lazard advised on Bear Stearns, Lehman Brothers during those years. I was involved in the Morgan Stanley recapitalization, saving that bank, investment bank, and involved in Fannie Mae and the conservatorship, advising the board on that process. So saw a lot of things firsthand during this time. So you can imagine over the last month, there was a big deja vu moment for me as I saw a lot of these things happening. So I want to use this time to share a few of those insights, what I think this all means and what it might mean going forward. I'm going to jump over and share my screen now so we can go through this and talk about it a little bit and come back at the end to share some parting thoughts. So let me do this. All right, so there we go. Moving on to where we are. So is the crisis over? Is the theme of this week. And as I'm sure everyone is aware, there were 3 big US bank failures over the course of March and a rescue all within a couple of weeks. Pretty shocking. In fact, that it was the number 16th largest bank in the US, Silicon Valley Bank, and the number 14th largest, First Republic, both of which got into some significant trouble around deposit flight. But in fact, there were 3 banks that were closed in a matter of 2 weeks, either shutting down, winding down, liquidation, in the case of Silvergate, the smallest. But then both Silicon Valley Bank and Signature forced to close by the regulatory authorities in their states with the FDIC appointed receiver, which meant that the shareholders no longer owned the bank. Management and the board were no longer in charge, but the FDIC was. Both of them ultimately had most of their assets acquired by another bank. And in the case of Silicon Valley Bank, those deposits were formally guaranteed by the FDIC, whether they were insured or uninsured. So this was a big benefit to a lot of businesses. Silicon Valley Bank, most well known for banking the tech sector, internet companies, crypto companies, very much involved in the tech and venture capital community, not just in California, not just Silicon Valley, but around the country. And so this one came out of the blue. It happened in about a 48-hour period, really 24 hours, where they had massive deposit flight. Once there were rumors out there that the bank was in trouble, they saw massive amounts of deposits leave, as did First Republic. Now, First Republic perhaps dodged a bullet in that for them, the ultimate outcome, well, maybe not ultimate, but for now, was that 11 of the 2 big to fail banks put in $30 billion of deposits to shore up their liquidity at a time where they had seen a deposit flight well in excess of that, and then hired my former firm, Lazard, to help find a buyer or some alternative for First Republic going forward. This is all pretty significant. Now, one thing to note, I find curious, is that the 3 S banks, Silvergate, Silicon Valley, and Signature, were all quite heavily involved in the crypto industry. And while they certainly had issues away from crypto, which we'll get into in just a second, it does occur to me that this may have been part of the regulators looking at this as an opportunity to take on the crypto industry as in the wake of FTX and other things. This issue didn't just happen in the US. We saw contagion spreading to Europe with the forced merger of Credit Suisse into UBS. Now, UBS, definitely a too big to fail bank. Both of these were 1.1 trillion in assets for UBS. 550 some million in dollar terms for Credit Suisse. This also happened around the same time, and in fact happened over a weekend. So you see here the share price of Credit Suisse before the rescue. Over the weekend, there were significant liquidity issues. Counterparties were refusing or beginning to refuse to accept Credit Suisse's transactions and looking for collateral, cash collateral up front. which was a significant issue. So the government, the Swiss government, had to intervene, and over the course of the weekend tried to find a solution. Ultimately resulted in Credit Suisse selling to UBS. Now, this chart from Bloomberg. Bloomberg has an interesting title here. UBS is buying Credit Suisse for a bargain. Well, it's true that they bought it for a significant discount, a take under to the share price just the week before. Certainly, what was ultimately £1 per share per Credit Suisse shareholder, 1 share of UBS, was a lot more than the zero that it would have been if it had failed and gone into bankruptcy through a liquidity crisis, which, as I understand it, was exactly what was happening over the course of the weekend. So let's just talk about this for a second. So the Swiss government forced Credit Suisse to sell, but ultimately it is the Swiss, taxpayers that are in a position to have to backstop this. So UBS pays about $3.5 billion for Credit Suisse's equity, again 60% discount to the closing price on Friday. But there were significant corners cut. So first of all, the government denied shareholders the right to vote on the transaction. They basically said this is a fait accompli, other than some procedural matters. And in fact, in a very unusual move, gave priority, allowing shareholders to get that equity value, whereas some junior bondholders in a type of AT1 bail-in bonds were basically wiped out. So $16 billion, inverting the normal capital structure where any kind of creditor, even if they were unsecured, would have gotten paid out before the shareholders did. I expect that these are points that are going to be litigated. I think the shareholder meeting has happened, but I don't think this is over here. The most important part of this transaction is the fact that the Swiss government basically backstopped it. UBS is not the ultimate risk taker here. They have received from the government a loss guarantee of up to $9 billion, so 3 times the purchase price. More importantly, the combined group has another $200 billion of financial assistance in various forms, liquidity assistance and otherwise, half of which is guaranteed by the Swiss government in the event of a default. So in other words, it's ultimately the Swiss taxpayers who are on the hook for this if things don't go right. Now, going back to the financial crisis in 2008 and beyond, the U.S., of course, took on a lot of these obligations through the TARP program, the Troubled Asset Relief Program. The original intention there was that they would buy assets from the banks. Instead, it ended up being a massive program to invest directly into the banks in not a formal nationalization, but a takeover or an investment in. Now, ultimately, the U.S. government and thus the taxpayers did get their money back. That was a very profitable program in the end. But of course, going into it, no one knows how this will work out. The markets just hated this. They saw a real problem here. So the day one share price reaction after Silicon Valley banks announced FDIC receivership and then ultimately the bailout of depositors, regional banks were just absolutely hammered over that Monday, the next day. The banking index down 10%, the too big to fail banks down much less. But you see here that a lot of the regional banks and smaller banks were really hit because there was a fear that this deposit flight was going to continue. Now, and in fact, if we go out to the end of the month, that fear of contagion across the banking sector is actually spreading and not getting better. So the overall NASDAQ bank index down 24%, too big to fail banks down anywhere from 9% in the case of JP Morgan and Citi to 16 to 20% for B of A and Wells Fargo, respectively. And those same regional banks equity value down substantially over that time. So let's just back up a second and say, what exactly happened? How did this occur? We have to go back to the course of events in 2022. This was the worst year ever on record for bonds. Remember that we saw over the course of, I believe it was 7 rate increases by the Federal Reserve during this time, raising up to, I think, let's say roughly 4% over the course of those raises. This absolutely hurt anybody holding bonds, any investment security. And in fact, if you look at the longest dated, the US 30-year treasuries were down 40% over this time as interest rates rose rapidly, less so for shorter duration. But this really hurt the banks because a lot of the banks hold these US treasuries as a presumably safe security where they know or believe that they're going to get their value out in the end. And banks can account for this one of 2 ways, either held to maturity, which means that's exactly what they intend. They will hold it. So even though they might have taken a loss today, because remember that when interest rates go up, prices go down because the interest rate that you're getting on that bond is worth less relative to the market value. But if you hold on to the end, you're still going to get repaid at par. So that's held to maturity. The other option is available for sale, which means you have to mark to market as a bank every time those interest rates move the price of the bonds. That is what caught Silicon Valley Bank in this spiral over this time. And the issue that I want to raise today is that this underlying asset problem, these investment securities that are holding unrealized losses, is pervasive throughout the banking system. So one estimate has it that there is a total of 1.7 trillion in unrealized losses across the entire US banking system, roughly a third of that in the too big to fail banks. Now, again, to the extent that those are held to maturity portfolios, it's less of a concern. To the extent that these are available for sale, those banks have to mark them straight away. What happened to Silicon Valley Bank was they were forced not only to sell the available for sale securities at a loss because they had this deposit around deposit flight, they were forced to begin to sell those held to maturity assets as well, which of course means they take an unrealized loss and they turn it into a real cash loss right away. When banks lose money, they also lose capital. As capital deteriorates, what starts as a liquidity problem turns into a solvency problem in that they start to have no capital. In other words, there are more liabilities than they have assets. That was the path that SVB and these other banks were on, Credit Suisse as well. This problem has not left the banking system. And if I had one message from this video today, this presentation today, is that this issue has not been resolved. We're still going to see this issue coming forth in the banking sector going into the second quarter of 2023. And in fact, depositors are aware of this. Now we've seen, according to the latest data from the Federal Reserve, 650 billion of deposits that have left the US banking system since year end. We don't have the latest figures from this week. It'll come out next week, but you see the trend here going from about 18 billion at the end of the year to now just 17.3, 17.4, and likely headed down in this past week. The issue is that depositors are leaving mostly the regional and the small banks. So the too big to fail banks, money markets, and the treasuries are actually, or treasury markets are actually winning in this environment. So why is that? Well, too big to fail banks gained in that first week after the Silicon Valley Bank collapse about 125 billion of deposits, viewed as safer, stronger, whatever the reason. But those banks are paying almost nothing on their savings programs, their deposits, their certificates of deposit, anywhere from effectively 0 to maybe 1.5% on year-long dated certificates of deposit. So on the other hand, because treasuries are now yielding 4 to 5%, even for very short duration, a lot of money has moved into money market funds, 600 billion this year, 300 billion in March alone while all this was going on. And some people are just investing directly in treasuries because it's relatively attractive. And also during this time of concern around what was happening in the banking sector, hard assets benefited and gained. We saw gold and Bitcoin up quite strongly in this time. That's a problem, especially for the regional smaller banks who rely on their depositors to help fund their assets. They're more exposed to loans, more exposed to commercial real estate and other issues we'll get into. As a result, the regional banks are being forced to turn to government sources for cash. So the federal home loan banks saw the demands on their cash pretty much effectively double since the end of the year. They in turn have gone out to the markets to raise money, to raise bonds, to cover their own cash needs, to provide liquidity to the regional banks. The Fed itself, after trying to trim its balance sheet over the last few quarters, we now see over the past 2 or 3 weeks has started to grow its balance sheet again by 100, 200 billion just over the last couple of weeks. Again, we'll get the latest information out. That tells you that quantitative tightening, if it's not over, it has certainly been paused, and we could be in another period of quantitative easing. We'll see how things go from there. Now, the big issue that ties to all this is we've been talking about deposits. That's on for a bank. That's the liability side. On the asset side is what they hold. We talked about how a lot of banks have gotten in trouble because on their asset side, they were holding treasuries and other mortgage bonds, investment securities that went down in value as yields went up. The other big issue for the for the regional and the smaller community banks is that they have a lot of commercial real estate still sitting on their balance sheet. They're the dominant lender to the sector. The big money center banks, the too big to fail banks, are focused as big banks on lending to big business. And so it really is these regional and small banks that take care of Main Street, that take care of the small and medium-sized businesses, local communities, and thus here's where the problem lies, that defaults and losses are piling up in commercial real estate. We see it especially in big city centers like New York and San Francisco, where vacancies have skyrocketed really post lockdowns and the work from home movement. By and large, workers have not returned, at least not in mass, at least not enough to make up for these significant vacancies. And as a result, these regional and smaller banks are exposed to further losses on the asset side. So this is a real warning and a flashing red light here for the sector. Now, the other issue is, how did this happen? Again, we said what happened and how. The Federal Reserve has a big responsibility here in creating the crisis, catalyzing the crisis by raising rates so quickly. You can debate whether they had any choice, whether they needed to in order to fight inflation, but effectively they raised rates so quickly that banks did not have time to adjust their balance sheets. You could argue, of course, that Silicon Valley Bank and other management teams should have done a better job in anticipating rate rises and all that sort of thing. Absolutely, boards of management have responsibility here. Nonetheless, the Federal Reserve is the one that lit the match on this. And created this problem by raising these rates in such a rapid period. I would have thought that after Silicon Valley Bank's collapse, they would have paused raising rates. They did decide 2 weeks later to raise the Fed funds rate another 25 basis points. So now we've got a target interest rate approaching 4.75 to 5% on the high end. However, their language has definitely turned neutral, meaning slowing hikes or stopping going forward. The question is it too little, too late? The takeaway that I want to leave you this episode is that the banking crisis is not over. The banking sector is in trouble. This is not going to end well. Commercial real estates may be the catalyst here for the next leg down. Certainly, they're deteriorating rapidly. The regional and small banks are the biggest CRE lenders, as mentioned before, and thus they're the most vulnerable. They're vulnerable on the asset side to losses from CRE and other loan markets, but they're also most vulnerable to deposit flight for the reasons that we went through before. Their model, their profitability requires them to be able to lend out and borrow from depositors at a very low rate. They don't have a lot of room in terms of their profitability to be able to pay more if the cost of their deposits are rising and the value of their assets are falling in such a way that they are no longer able to either deal with the liquidity from a deposit run or deal with solvency from valuation decreases on the asset side. So deposits are unattractive right now for most, whether businesses or individuals. When they look at non-bank options, money markets, treasuries, much more attractive. The too big to fail banks are perceived as being less vulnerable. However, in the sector, they do carry a good portion of the unrealized losses, around a third of unrealized losses from investment securities. Punchline: credit crisis is coming. Absolutely. Why? Because the cost of borrowing is going to increase. Even if even if the Fed funds rate is flat or downish going forward, risk premiums for these banks is going to go up. They are going to be more reticent to lend. Capital is going to be more scarce. You see it if you don't have both the capital and the liability side, the deposits, to grow assets, then you're going to limit lending. So what happens here is that as these banks incur more losses, their capital deteriorates. They're forced then to reduce assets, reduce risk-weighted assets, and that means restraining lending. So the result of all this is a credit squeeze. And again, we've said this, but the small and medium-sized businesses, well, the banks, but the businesses on the other side, local businesses, medium-sized businesses around the country are the most severely impacted. Just as we saw in lockdowns, it wasn't the Amazons of the world, the large corporates of the world that were affected. It was local neighborhood businesses that really were squeezed. This is likely to happen here in this credit crunch. The result of that is that economic growth is going to be constrained for the foreseeable future. And whatever the odds were, the probabilities were of recession in 2023, they have absolutely gone up as a result. of this credit crunch. Now, one statistic I saw very interesting is, in many ways, the credit crunch is already here, purely from the rising rates environment. So what you're seeing here is global syndicated loans. So these are loans that are going out across banks, across regions. And you see that volume over the last year has been cut by some 55, 60% from peaks towards the end of 2021, first part of 2022. And in fact, according to Bloomberg's estimates, this is the lowest rate of syndicated loan sales since 2010. So even before the crunch, the deposit flight that was happening, we saw that rising interest rates were having a significant impact on businesses, investors' willingness or ability to borrow, banks' ability, willingness to lend, what the market would absorb. So we're already facing this moment today. So just to close it out, a couple of parting shots. Banks fail one of two ways: either illiquidity, they don't have enough cash to meet their obligations, and that's often what really triggers bank crises and bank collapses, or insolvency. What happens is liquidity crises can quickly become solvency crises, as we saw with Silicon Valley Bank, as they were forced to sell more and more assets more and more quickly to accommodate this rush of depositors heading towards the door. Now, when these things become systemic, it happens generally in two stages. First, gradually, and then suddenly. We saw that in 2008. We had the Bear Stearns wave in March, and a couple of other, well, not just a couple, but several other big banks around that, Washington Mutual, others, et cetera, earlier on, had a pause, had a lull, maybe everything's okay, went through the summer, and then Bear Stearns weekend in March, Lehman Brothers weekend 6 months later in September. So the warning here is that we've had a little bit of a week or two of calm. I don't expect that it's going to last. I think we are going to see other issues and another leg down. And just to size the numbers a bit, the entire banking sector deposits, we saw this earlier, it's over $17 trillion in total deposits. The FDIC's entire deposit insurance fund, the FDIF, is $128 billion or so. So in other words, less than 1% of total deposits. The Treasury offered up a backstop of $25 billion as part of the Silicon Valley Bank bailout. It's a salve. It's nothing compared to the total deposit environment. So then we're back to the question of where does it end? Do we end up in a situation, where I'm going to stop this and come back to you, where in the next leg down, in the next round of deposit flight or runs, that somehow the US government is forced into a position of having to provide liquidity to the entire system and or deposit protection to the system broadly, keeping in mind that the entire balance sheet of the Federal Reserve is, we saw earlier, $8.7 billion, trillion. The debt of the US government, $31 trillion, and we're looking at $17 trillion of deposits. So these are numbers that don't quite work in the whole. I'm going to go ahead and wrap it up there. I hope you found this useful. If so, really encourage you to like it here on YouTube, to share it, and to subscribe to my YouTube channel here, Michael Wilkerson, Stormwall. And also, you can catch up on everything I'm writing and talking about at stormwall.com. There are a lot of underlying articles that were published over the last month talking about this issue. If you want to go into it in more depth, certainly welcome to. And you can check out more about Stormwall Advisors at stormwalladvisors.com. Thanks for joining me. We'll see you in a few weeks, hopefully with some better news.